Hey traders, Chris Pulver here. Welcome to the Weekly Outlook. We're talking about stocks, Forex, cryptos for the week of March 30th through April 3rd. It's going to be a busy week. We'll take a look at the markets, review some good opportunities, and know that we're probably going to have some volatility ahead. But I think the biggest thing here is that this is a reality check for the stock markets. We have experienced some bazooka-type fiscal stimulus coming out of the U.S. and the Eurozone. We've seen central banks slashing rates around the world. All I can do is think about what has happened in the past to try to compare it to what's happening right now. Obviously, in 2020, it's not the same market. It's not the same problem that we had back in 2008. But I think price action is actually showing some similarities. So that's what I want to talk about today. So we'll take a look at the economic calendar. We'll find some directions and bearings for the week and figure out where the best opportunity lies. If you are following me out there on YouTube, Instagram, Twitter, you can find me out there, pulver.chris on Instagram, at pulverchris on Twitter and Facebook, YouTube. One thing that was interesting to note, you would think that the usage, which has been dramatically higher on Facebook and on Twitter and on Instagram, usage has been incredibly high because of self-quarantining, social distancing, and people staying at home. But it's interesting to note that this is not translated into more dollars and growth for these respective social media platforms. And the reason why is because ads and marketers are not looking to put tons of ads out there when nobody is buying. Right now, the consumer is contracting. Right now, the consumer is saving. And we are in for some potential retail pain ahead if we haven't already experienced some. I would say ending Q1 and starting off this Q2 with April. This is a really critical time for really the health of the U.S. economy. I mean, we have a $2 trillion stimulus package that was put into play and voted into law last week on Friday. We have the Defense Production Act that was passed as well. Companies like 3M, Ford, General Electric, General Motors, all mobilized to start producing respirators, ventilators, and things like that to cover the health system shortage. And it may not be just for the U.S., but also abroad. One thing that we are tracking every single day is this is the Johns Hopkins coronavirus tracker. And, this is pretty depressing, but it's also good information to see, are we going to start noticing a transition or a tipping point? I mean, last week, the U.S. cases were right around, 85,000, got up to 100,000 over the weekend. You can see that the U.S. cases continue to soar. The U.S. is now leading the case count. So, well ahead of China. China's plateaued here right around that 82,000 mark. China's starting to get back to normal. Manufacturing plants are starting to open back up. Travel is back allowed. Stores are opening back up. And I think all eyes will be on China as well to make sure that there's no second wave of cases, no second wave of this, plateauing, all of a sudden escalating once again, if those social distancing efforts or quarantines that China and South Korea and Singapore and other countries have implemented start to all of a sudden go away as life, kind of, quote, returns to normal. Meanwhile, Europe continues to be a hot spot. The U.S. cases continue to soar. And again, this just becomes a very scary time. So on that note, this is what maybe look into the stock market, look into comparisons for, what's the worst time we've seen in the last 10, 15, 20 years? Well, 2000 to 2001, 2008. So that's what I started to look at going into last week. So take a look at this. This is the S&P 500 on a weekly chart. This is actually the SPY. And I think we can find some similarities with this price action back in 2008. This was September 2008. This was about as irrational as the price action became in 2008. So yes, we had our kind of drifting higher, tons of divergence. You can see that the market's making higher highs, higher highs, higher highs, disagreeing there with momentum. And then we start to decline. We have a nice, topping pattern, equal lows. We break that neckline, starts to sell off. This was what I said, irrational pricing. I mean, this was about a 30% drop, which is what we just saw in the U.S. markets here the last, 2 or 3 weeks. We saw anywhere from 25 to 35% corrections across the board between the NASDAQ, the Dow, and the S&P 500. And this is what I thought was interesting. Look at the next couple of weeks. Okay, in fact, once we had that kind of 30 to 35% correction, we had this massive indecision candle for the week. And that was around an 18 to 20% candle. Now, if you were watching the U.S. markets last week, we had that big 30 to 35% correction. We had a 20+% surge. Okay, now I think that the markets are playing with the emotions of the bulls and the bears, because anything below 20% is deemed a bear market. Anything above 20% is deemed a bull market. And these, 1,000+ point swings on the Dow have given, those 10 and 20% levels tests and confirmations. So we've seen a bear market confirmed. We've seen a bull market showing a short-term bottom. but let's take a look and see what the market's going to do. So the reason I think this is important is because as we go into this trading week, it looks like President Trump is looking at an extension to our social distancing extending through April 30th. We had a 15 days to end. That was supposed to be, now. Now we're looking at 45 days to extend through all of April. So social distancing, stay-at-home mandates, all these things will be happening in the U.S. States will most likely adopt this over the next 2 to 4 weeks. And I would suspect that the mandates become even stricter. So it's just essentials. If you need medicine, you need to go to the doctor, you need groceries. That's pretty much it. So anyway, but this price action right here, having that big drop, having that quick recovery, this is what transpired over the coming few months. So we had, this was in September, October right here. This is end of September and early October. We had one giant correction candle, and then over the course of the next several months, so this was getting into October, getting into November, getting into the end of the year, December, we didn't turn the corner officially. If this was October, it was 3 to 4 months later, actually establishing that bottom here in February and March. So obviously the seasonality from the financial crisis of 2008 is very different, but fast forward to present, and let's go into this. So let's fast forward over here to present time, and we have our big drop. So there again, from our high around 339 to the low around 218, so 339 minus 218 divided by 339 off the top, we had a 35, almost 36% correction from the top. From there, we go from this low at 218 to the high at 262. So 262 minus 218, that's a 20% rally. So we had a 36% correction, a 20% rally, but you notice that the close did not sustain. Okay, now granted, this candle from last week does not look the same as that indecision candle back in 2008, but what I'm discussing here, what I think is likely going to happen is the, look, this is why today's weekly outlook image is this. Okay, the image is this, reality check ahead. Because I think the reality of the stock market is this, throwing $2 trillion at the economy, throwing $2 trillion to kind of fight coronavirus economically doesn't necessarily change anything. We will likely still see cases increase. We will likely still see the death toll continue to rise, and business will continue to be impacted by this. Now, can it offset some of the damage? Yes. Can it slow down the extremes and the panic? Yes. But I don't think that this is over. So, for all of the analysts out there talking about this is probably not the bottom, this is probably going to get worse, I don't know if we're going to see this type of irrational movement like we did the last few weeks. So this was the panic pricing. I think what we're going to see now is slightly slower. So we have this, decline, we have a little recovery, we're probably going to deal with some indecision. I wouldn't be surprised if this is a slower decline as reality sets in. We have an important non-farm payroll number this Friday, which shows the job report from March. We had unemployment claims at a massive high, 3.3 million unemployment claims. I think the forecast for the calendar was 1.6 million, which is super high, but it came in at 3.3. And yet some estimates were like, well, we expected 4 or worse. And so somehow the news is actually interpreted somewhat positively. But again, that's a ton of jobless claims. And then we also have to watch for continued claims and see if that ends up shattering some of those historical highs around that 5 to 6 million mark. So I think that price will do something like this. I don't think this is the bottom. Okay, I think that this is the aggressive bear pricing. I think that the bears are still going to want to push and retest these lows. And from there, we might have this week or next week over maybe the next few weeks to start off Q2, slow and choppy. We might quickly come back in to retest the low, and maybe the market just wants to get this over with. Maybe the market wants to come in, test these lows, show those extremes in price, show those disagreements, and then we get into the end of April into May. But unless May is going to see a big recovery, this might just drag out. This could be, this area off this correction where the bears are really showing control, but maybe the bears are just really slow to go much lower. I could see this happening here where it just kind of melts a little bit lower, and then we're just kind of waiting for the catalyst to recover. Maybe it's somewhere in the summer. Maybe it's a transition month in August, September. Maybe it's post-U.S. election. I would hate to think that we're going to suppress volatility this much and this quickly, but the fact that we just had $800 billion out of the Eurozone, $2 trillion out of the U.S., there's so much excess liquidity now in these financial markets that's what we saw happen from 2012 to 2017, 18, 2019, where volatility was at an extreme low because of all that excess liquidity. So the last few weeks I've pivoted to scalping and more short-term trading, and I'm still going to continue to do that this week. My Flex trading room will be changing schedules for this week. If anyone is interested in joining me, you are all welcome to join me. You can come into smarttrader.com, go into Marketplace, and there is a featured link for the Flex Trading Room. You can join me this week and for a month, or you can join me as long as you want to. But I'm going to change my schedule this week and be live from 4 a.m. to 6 a.m. Eastern Time, Tuesday the 31st, Wednesday the 1st, and Thursday the 2nd. So anyone wanting to trade that UK session, that London session, get the kind of pulse of the market for the morning. And, price has responded really nicely. I had some robots running this morning. This was a look at my pound pairs. Pound Aussie was running nicely. This actually shifted over. I have not been in the sell zone. I traded this portion this morning. So pound Aussie played out pretty nicely. This is where I was looking at buy zones and breakouts after that 4 a.m. Handle. So I had about an hour of price action. I was waiting for a nice official breakout, had some trend zones stick up, and the pound is fairly strong on my currency strength chart. So the pound Aussie worked out pretty nicely. The pound CAD worked out pretty nicely. They worked out very nicely. Pound yen, same thing, and even the pound New Zealand. So everything offered me a nice clean buy zone this morning on the pound pairs. Did some nice scalping, and result-wise, ended up closing out short-term for some trades there. So that was respectively about 360 pips on the morning with a nice little robot there. This is my Right Trader Max robot that I've been having trade a lot for me over the last couple of weeks, and it's been fantastic. And a lot of that is just because of its agility on smaller time frames as well as higher time frames. I closed out trades on the pound US dollar right here. Pound US dollar was a 30-minute chart. There's 43 pips. And my favorite was last week, going into the end of the week Friday, 485 pips. So it can pick up trades on the 30-minute, the 1-hour chart, the 1-minute chart. It just really depends on finding the right trade, trading with the amount of precision you're looking for. But I like this higher volatility environment that we're in right now. The pound pairs are moving better than the euro pairs. The euro pairs have really changed their tone. We had, kind of risk off, and euro was getting safe haven bids, and the dollar was all over the place, and the euros were going bananas, and the euro pairs were moving a ton. That has since taken a step back. I think after the ECB unveiled their big purchasing program once again, the volatility has kind of been suppressed in those euro pairs, but pound pairs are on the move. So I am focusing a little bit more on pound pairs right now, which is fine. I just want volatility, want movement during those London sessions, or those active zones. So anyway, that's some scalping stuff. If you want to join me, you can. Flex Trading Room. You can find that in smarttrader.com. Go into the marketplace, and it's right there. So this is for everyone to join if you wish. Anyone out there that's following me on social media that keeps asking me, like, how do I get in your trading room? How do I trade with you? This is the best way to do it. Okay? All right. So let's go back to the SPY really quickly. So we had our big decline. We had our recovery here, but the market kind of faded that move a little bit. That's still a pretty decent size bullish weekly candle. All right? Now, we could still pull back into, we are just shy of the 38%. We are just shy of the 50%. So if somehow this week starts out on a positive note, that's fine, but high to low and then hitting a 38% or 50% retracement, more than likely that is going to be met with some selling. And so if we start to see some bearish activity this week in the stock markets, expect this to increase volatility. This will most likely favor the yen, favor the Swiss, possibly even the dollar this week. But more importantly for me is that we just have volatility. If there's volatility, I can find some trades, I can find some direction, and I can find some short-term profits, which is fine because I can use those to either be more patient on my long-term positions or I can use those to wash away some bad positions. So I would not be surprised this week to see price, again, 38% is sitting right there, 50% to balance out this move, but I think that will be met with some resistance, and I think the bears will say, okay, we had some fun. It's time for us to really push this and kind of step on the throats of the bulls right now. But again, it's probably not going to be as fast and as violent and as crazy as it was when we had this initial decline. So if the bears come back in around that 382 and 50, it might be a little bit slower to the downside. Once we end up getting back into these lows, I think that really is going to slow that momentum down. and then we'll deal with something like this. We'll deal with some type of channel and some type of extreme, and then eventually there's going to have to be a catalyst, maybe when we come out of this coronavirus at the end of the month, maybe end of April, something that, assures us as humans that this is safe. It's safe to come out. It's safe to get back to normal. And then economically, that businesses are open back up and things are getting back to normal. But that time it remains a big question mark. So I'm really this week going into thinking, okay, we have a short-term bottom, but I don't think that's the bottom. I think that off these levels, most likely the market's not done selling. So we're probably going to have some moves that want to fade back down and retest those lows. What I'll be watching this week, I think in order to gauge some of that direction, keep an eye on the volatility index, right? So this massive spike from last week, look at this. We had a spike down to 34, all the way back up and ended up pushing, as high as 77 once again, closed around 65. Let me go into the daily chart here on the VIX. Okay, so if we simply have the VIX staying above 50, I think if we're firm above 50 on the VIX, so right here is really my line in the sand. If we are going from this high to low, kind of consolidating here, and we start to see an uptick, if we see an uptick in the VIX once again, coming back to retest those highs, then I'm going to be aggressively trading on those smaller time frames, because this higher tick in the volatility index should mean higher volatility across the board in the markets in general, but certainly in Forex, where I'm looking at some short-term agility every single day. So part of me, for at least the near term, wants to see another push higher in the VIX. That gives me two opportunities. One is I can trade that in Forex, and I can get some nice daily opportunities in Forex for the pound crosses, euro crosses, perhaps, trade those higher volatility majors and crosses. But also, if we retest this high on the volatility index, that also gives me an option play on something like the VXX to actually buy puts and have this go into the money. Basically saying, look, if it's up here at 85 or 90, and I look at something like the VXX, which had I think it had highs around like 75 right here. So we had highs around 78 on the VXX. If we end up getting back to those highs, back towards those highs, I think if I bought puts and set that out 90 to 120 days and just had this get in the money, I would end up capping, how much money I can make on it for the option. But at the same time, I think this would be a safe trade to short as high as possible. So the way to short that for me on the VIX or the VXX would be to buy puts and have this be in the money probably 90 to 120 days out. Two things I'd look to trade. Number one is Forex is if the volatility index increases and tries to get back to those highs. The other, and I'll throw this out there as well, if we get below the 50, if the volatility index comes back below 50, then I think all this is going to be just a very ugly end to volatility. We had this exciting time for 2 or 3 weeks. If the VIX closes below 50 and starts drifting back down to gaps and tries to resettle back into $20 and $15, then expect the Forex volatility to start to disappear. And I will start scaling back that short-term trading. In fact, I won't really look to be scalping much at all, because that is a very different environment than what we have right now. So for me to be a scalper, for me to be looking at short-term profits, I need to see the VIX stay up here. If we get below 50, then I will not be engaging in that short-term volatility as much as I am right now, which, by the way, to put it in perspective, it has been extremely lucrative. So this is what's been happening over the last couple of weeks. You can see Right Trader Max has been a big portion of my trading, and a lot of what I've been doing over the last couple of weeks have been just positioning myself for short term. So that is over 4,000 pips in 2 weeks of trading. So I am not looking forward to suppressing volatility. I hope it doesn't happen, because it's very profitable right now. And that's good. That's why I've switched my schedule around to trade the active zones and trade the London session, and also have a pulse on that overlap. The London and the U.S. session have so much volume and volatility that the markets like to move. And so I'm trying to put myself in a position to jump on board and trade some precision with those areas and get those movements. And you have really simple buy zones and sell zones like this. This is a nice buy zone. It's just straightforward. You wait a little bit of time to see it confirm, but when it does confirm, it does take off nicely. And give yourself some opportunities to trade. So I don't want it to go away. I want the volatility index to stay where it is. I want it to go higher. I want it to retest those highs. I think technically it would make sense for the market to find those rebalancing points and find these retracement levels like the 382. This is a Fibonacci swing, so the 38%, the 50 are very common numbers. The 38 is officially a fib number. The 50 is perfect balance. So I could see those levels being hit. I could see those levels being hit hard and also met with resistance. And then we start seeing that the dose of reality that the market needs, which is, look, this coronavirus stuff is real. This is affecting the markets. This is potentially pricing in worse things before it gets better. And again, that's what I'll be watching a lot of this week. So, what am I focused on? If you want to take a look at my workspace, this is what I'm using in my trading room. I'm looking at nothing more than a few currency pairs on euro pairs and pound pairs. And I'm getting some intraday structure right around that Euro Open and London Open, and just trying to trade kind of the flow of the morning. So I am using a currency strength chart. I'll go ahead and refresh this. So I'm looking for something that is obviously strong or weak or starting to move a lot. So this morning I noticed that the pound, this is last night around 11 p.m. and then around 3:30, almost 4 o'clock in the morning, the pound was aggressively coming off these lows. Now it doesn't look like much when you see this. But in real time, when these are aggressively coming off these lows, and I'm looking at pound pairs that are starting to really surge on those 1 minute and 5 minute charts, it put everything into a buy zone. And so as this started to move and started to get back into, look at where the pound made that move. That's one of the bigger moves that we saw this morning on the currency market. So pairs, like anything against the pound, that run right there provided about 100 to 150 pips of opportunity. And I can trade it. So that's what I'm looking for. Same thing on euro pairs. I mean, euro was down here in the middle, kind of baseline with all these other pairs. If it was euro at the top or euro at the bottom, I would have been more excited about trading euro pairs. But the pound was starting to make a nice shift, a nice move for the morning. So that was one way to look at it, just what's strong, what's weak, and what's on the move, and where's my volatility. So that's short-term stuff. Longer term, talk about some directions. One thing I will be trying to follow for the next couple of months is this sentiment strength line or momentum-based chart. So that means when price is closing higher, it continues to stay green. If this reverses and starts getting bearish closes and consecutive bearish closes lower, it will turn red. So between the daily, the 8-hour, the 4-hour, I will be looking to follow that direction as much as I possibly can over the next couple of months. Trending zones, trending seasons, April and May are typically pretty trend friendly. So I'm going to do whatever I can to try to follow along with those levels and really just try to stay with the overall trend. So if I see, 1 hour structure in a sell zone, even if I want to go down to a smaller time frame, I'm going to stay somewhat biased towards that 1 hour sell zone. Flip that around. If it's a 1 hour buy zone, I'm going to stay fairly biased towards a 1 hour buy zone, even if I want to go down to smaller time frames and trade in that direction. So if I had a 1 hour chart that is showing sell zone, then if I want to trade a 30 or a 15 or a 5 minute or even a 1 minute, I would be focused on trying to stay in the aligned direction. The 1 hour chart, you can eliminate some market noise. You can prevent yourself from getting into these big swing trades. And hopefully there's going to be some pretty smooth direction and trends coming over the next, 6 to 8 weeks. If it was bullish, I had 1 hour buy zone, then I would go down to a 30 minute, a 15 minute, a 5 minute, or a 1 minute, whatever time frame you're comfortable with, but look to stay in those aligned directions to trade with that extra precision and accuracy from a smaller time frame. This is a really nice pair to keep an eye out for because we had all that volatility. Here was our flash crash high from like March 8th and 9th. We ended up blowing through those highs with this giant move. I think that was really the move that exhausted and crushed and hurt and flushed out the retail traders that just couldn't hang on any longer in the wrong direction. But of course, if you're with the trend, as we were in my trading, we were trading day to day and we're getting this move. We had a ton of movement to the upside as well as the extremes that we started to short this back down for balance. But right now, you can see that this crazy high, crazy low has now created a lot of consolidation. And so this is what I meant about the VIX. This is what I'm talking about with the volatility index. If it doesn't go higher again, more than likely this is going to be suppressing volatility. We're coming back down to the lows, look for it to bounce. Coming back down to the lows, look for it to... there's ways to trade this because this is now a fairly large channel. We went from, thousands of pips up. This is about 2,000 pips up, 2,000 pips down, and now we have about a 700 pip range on this Euro Aussie. So there's opportunity for sure. We're in the halfway point. So if we can finally see this market, make a break for it, there's a few hundred pips to the downside. If it holds these lows and gives us a nice bounce, there's 700 pips to the upside. So we can stay within some of these larger ranges that have been established from this wild volatility over the last few weeks. But it's not the same. this movement is not the same as this. Day to day, intraday, it feels very, very different. So I am having to pick my trades better. I'm having to pay attention and stay patient and not force anything because there's just not, 700 to 800 pip daily trading ranges anymore. I think that right now, this, crazy run we had, we're going to see maybe 100 to 200 pips a day on a lot of these currency pairs, which is good. That's great. That's still volatility. But I think the 500 to 1,000 pip candle is not going to happen anytime soon, at least right now. So, what am I looking at overall direction? I think Aussie still has room for recovery. I like Aussie's strength in the near term. I think with the oil prices dropping, I had a chart alarm go off last night that oil's dipping below $20. So let's go to oil really quickly. So oil is down to $20 on the nose. We are noticing again that price is retesting these lows. We are extremely oversold in oil. Okay, this could be a little bit more pain and pressure felt by oil before we start getting, a catalyst to the upside or just getting a convincing candlestick, which we don't have yet. So perhaps an aggressive trend line break, but watching this low, watching this low, watching this low, looking for disagreement, which on the daily chart, it's not incredibly obvious. So a bullish candlestick would be nice to see a little bit more confirmation. We are definitely oversold on the weekly chart. But I don't think that jumping in to buy oil right now, unless you're, willing to sit in some pain and sit in some drawdown, we could definitely go from $20 to 15, possibly to 10 before there's a move. So I wouldn't force that trade. I think that with this higher volatility, with this risk-off environment, I'm not about calling tops and bottoms. I think you trade confirmation. I think that oil has a promising recovery ahead, but in order to get there, we've got to see some price confirm that we're going to turn. So when oil turns, we can have some CAD strength. But right now, I think the Aussie's on pace for a nice recovery. Aussie CAD long looks fantastic. Aussie Swiss long looks nice for recovery and balance back up towards levels, again, that are fairly conservative. I mean, past lows and flash crash levels around 6,450 to 6,500. That would be totally acceptable to balance this move around 64, 65 and get out of the trade. If I have trades in, I'm long on Aussie Swiss. If I get back to 64 and 6,500, I'm going to be protecting profits. Okay, Aussie dollar, same thing. If we get back into 65 and 66, I'll be protecting profits and getting out of this trade. So, on the daily, on the weekly, even the monthly chart, some of those big moves on the Aussie have been enough that it has made me take a second look at these historical levels and the significance of them. I'd love to think that the Aussie is going to be this just giant technical recovery. But fundamentally, where we are with the current stock markets, where we are with a bear market or potential, risk-off environment, the Aussie is not going to benefit from a risk-off environment. So technically recovery, yes, that looks great. But in the near term, once we get into some balance points, mitigate some of that exposure, get more neutral, and then trade what we see. And if I'm going to recover and get back to neutral, make some profits on this Aussie recovery, so be it. But from there, I would be prepared for balance, and then the market has to decide whether or not the Aussie is going to fulfill this recovery and keep going up with this bargain price, or the reality is, nice recovery, nice balance, and then risk off prevails again. And we see the same thing that drove this extreme to the downside start to come back in and, hurt the Aussie once again. And again, maybe this is now, but later this year, maybe we have this just amazing commodity recovery. Maybe oil recovers, commodities recover, and the Aussie benefits from that. But I think that the markets as a whole, they have to get out of this coronavirus hangover, and that's probably not happening anytime soon. We're probably easily 15 to 30, maybe even 60 days away from having any real light at the end of the tunnel, because the cases continue to climb, the mandates continue to climb, and I think more and more things are getting extreme with how to prevent it or how to curtail it. So anyway, Aussie looks good, at least in the short term. I think CAD is going to continue to stay somewhat weaker. This week, depending on what the volatility index does, I'll take a look at the currency strength chart. If we start noticing that day to day, the yen is on top. Okay, if we have yen strength, dollar strength, Swiss strength, that is risk-off trading. So watch a currency strength chart. You can find this on FinViz. You can find this in broker platforms. You can find this inside Smart Trader. We have a basket widget that gives us these, hourly and 4-hour and daily. You can pick your time frame that you want. But I love the idea of just kind of real-time price. I mean, I refresh this chart every 5 minutes. So I want to see what's happening during the morning. I want to see what's happening in real time. What is strong versus weak? because not every day can we just find my one favorite currency pair that I can trade. Instead, what's better is let's find the strongest versus the weakest, or let's find a currency pair that's willing to move, and I can trade that pretty aggressively. Any other key directions here? Aussie pairs, one trade that still remains my favorite, Aussie New Zealand. We're back up above 10200 on Aussie New Zealand, and I'm looking for a longer term move. This goes back to 2015 as well. 2015, we ended up bottoming out here. This was, March and April of 2015. So if we can see a transition on Aussie New Zealand to the upside, looking for something bullish, then I think that Aussie New Zealand has a pretty convincing case to get back to 107.50, 108.50. And I mean, this would be my favorite move ever if we get to 114. If we hold these lows, and this goes back several years, if we can hold this area and just make this amazing move, even if it's just a big range, from 1.00 to 1.14, 1.00 to 1.14. If I could hang on to this trade, I will take a 1 week vacation because I'm really interested in this trade. I've talked about this for months and months and months. 107 to 108.50. I already have my target set. But if I can somehow see this thing just blow through 110 and just keep going up, and I can hang on for dear life, then that's going to be an amazing profit. So we'll see. Maybe over the next couple of weeks we can find out, what this thing's really made of and how much the bulls really want to run with this. Elsewhere, like I said, with oil on the decline, I'm looking for some short-term bottoms in oil. I think oil has a promising recovery ahead. Dollar pairs, dollar. Let's see. Let's go Aussie dollar. We did euro dollar. Let's talk euro dollar. Some of the majors here. Euro dollar. Really just a big shakeout in volatility. Okay, so I do expect oil to do the following. I think we're going to have this, big swing, which we did from low to high, high to low, low to high. If we start noticing a higher low and a lower high, then we're going to have some indecision. Okay, this is not going to be a promising environment to trade because it's going to be difficult to pinpoint these tops and bottoms. Okay, I would like to think, and I hope this is the case, that we end up, getting back towards the highs and either failing or getting back towards the lows and failing. Somewhere where we can still look at buying low with minimum risk, confirm something bullish and buy low. Get back to the highs and fail and confirm selling high with confirmation, right? Confirm this area, get some confirmation on a smaller time frame, sell high with a stop. Trade with confirmation, trade with confirmation. But I think overall, I think that this is going to end up doing this. With this high volatility move, I think the dollar in general, the dollar index is probably going to deal with some indecision for now. Speaking of dollar, let's go to the dollar index. So US dollar here, same thing. So now it looks like the euro dollar, it really didn't set up the extremes on the dollar index that it did on the dollar, the euro dollar. So I think that this, high to low, low to high, and this little drop, we've come back into previous resistance that could become some short-term support. But the key here for the US dollar is if we end up drifting a little bit lower, we might see that indecision play out like I anticipated on the euro dollar. So maybe some wedges forming here. I still think that in the near term, why should the dollar get weaker? Now, if we don't have too much of a risk-off environment, I think that we could see a weaker dollar for a couple of reasons. One, we've seen the Fed slash rates. So now it's pretty much the same as every other central bank. The Fed is sitting at 0 to 0.25%. That brings it pretty much on par with the RBA, the Reserve Bank of Australia, the RBNZ, who slashed rates at 0.25. The Bank of England cut rates last week to 0.10. The Eurozone's at 0%. The Bank of Japan's at 0.10 negative. The Swiss National Bank remains at negative 0.75. It was the race to the bottom within 2 to 3 weeks. So the Fed doesn't really offer the incentive to hold. However, it is one of the world's largest reserve currency pairs. The special drawing rights has, there's just dollars circulating all over the world. And with another 2 trillion going into circulation, there's more dollars to have. So is that a good thing for the dollar? No, it should actually help devalue the dollar. Interest rates are less of a motivator to hold the dollar. And the fact that the U.S. is really on the cusp or brink of, a recession. We're looking at job numbers and a country, countrywide. Obviously global slowdown, yes, but countrywide, it's definitely hitting home with everyday lives that are affected by coronavirus and things that are happening right now in our world, our everyday life. So I think there's definitely reason for the short term to have a weaker dollar. If the volatility is nice and high, that'd be nice to take advantage of that. But I'm right now with trying to avoid the wild swings and trying to be a position trader. I'd rather just take advantage with accuracy and precision. So just to kind of wrap up the video for the day, I know we've gone a little bit long, it's like 30 minutes into this. I am using Right Trader Max. I am using, systems, strategies, aggressive trending systems to follow alignments. So my plan that I would leave you all with today is, if you have a fairly nimble trend system, and it doesn't have to be Right Trader, it can be anything. If you have different moving averages that you use over the years and you like them, use them. But whatever the alignment is of, say, a 1 hour chart, if it's bullish, then stay bullish. If it's bearish, stay bearish. But then pick the time frame you want to trade in order to have that accuracy. So trade the 15-minute chart in the direction of the 1 hour. Trade the 5-minute chart in the direction of the 1 hour. And stay with that accuracy, stay with that precision. And that way the 1 hour charts, they can, look, the 1 hour chart can just flow. If we're going to see this, nice breakout on the 1 hour and it stays bullish, there are so many trades that we can take. And we can have defined stop losses. We don't have to have these big predictions. We don't have to follow along with, what's the weekly and monthly chart telling us? That takes all this time to go from start to finish. During this week, we can see trends that run from today, tomorrow, and they last all week, and we have lots of opportunity to participate. And the same thing is true here. If we go from a bottom to a top and we transition, the 1 hour chart will start catching most of this move here that you can trade with some accuracy, and then start transitioning into a sell zone that you can trade with some accuracy. So you can stay properly positioned and not get yourself into too much trouble and not be overly biased. That's what I'm trying to do right now, is I don't want to be overly biased. I'm trying to do my best with some short-term opportunities as volatility is fairly high. And if the volatility index remains high, then that's a good thing for Forex trading. If volatility remains high, that's a good thing for trading in general, because one thing we need is movement. Okay, so speaking of movement, here's Bitcoin, where we are currently sitting around the mid-sixes. We're at 63.46, still looking to see, how exciting can cryptocurrencies get, especially if the dollar ends up getting weaker, because that is the exchange. It's BTC versus USD. It still needs a big leg up. We had our yearly pivot. I was actually pretty excited about cryptos this year at 81.50, closing above that, getting up towards 10.5, but we had a big hard reset. So there is definitely a pocket right there. That's a nice inefficiency that clearly Bitcoin in the short term is going to find. That's right around 7,700. If we end up getting back above this yearly pivot, I would look for other cryptos to do the same thing. If we get back above and close above these yearly pivots, then the bulls might be able to come back and revisit 2020 highs as we kick things off. So there might be some legs in cryptos over the next 2 to 4 weeks, especially if the dollar gets weaker. The euro dollar, pound dollar, other pairs. Aussie dollar, New Zealand dollar are due for some nice recoveries. Technically, it's been like that for a while. And with a weaker dollar, those pairs tend to shine. So I like Aussie strength. I like New Zealand strength. I like pound volatility. And I'm looking to stay, again, agile, nimble, and trade, kind of no greater than a 1 hour chart. So always keep your context of a higher time frame. But as far as finding trades during the week and trying to, mitigate some of that risk and not be stuck on the wrong side of trades, stay with that 1 hour flow and then trade the positions on smaller time frames. So just a couple things to wrap up. Again, if you're following me out there on social media, and again, don't leave this video. Give me literally 2 minutes. Social media, Instagram, Twitter, Facebook, YouTube, my channel. Big shout out to my followers. We're up over 2,000 subscribers, and that was literally at 0 last year. So, part of it is just the effort of posting videos and keeping it consistent, but I appreciate all the feedback and the comments. I hope you're, willing to pass on my links to other traders and communities out there, because I'm trying to get some good information and free education out there for anyone that is following and wanting to listen and wanting to learn. So that's awesome. Keep those likes and comments and feedback coming in, and keep those followers rolling in. Also, if you want to join me in my trading room, smarttrader.com, go into the marketplace link. You can sign up for the Flex Trading Room, and we'll be trading live Tuesday, Wednesday, and Thursday this week. And lastly, on Facebook, you can join me live. This is free for anybody. On Facebook, Thursday afternoon at 2 p.m. It will be Thursday, April 2nd. I will be live with my friends Gary Fickhart and Tyson Clayton. Will be live at 2 p.m. Eastern Time on Thursday the 2nd. And we're going to go Facebook Live from our Market Traders Institute Facebook page. So you can check that out. The information has been awesome. We have a lot of fun doing it. We took some trades. In fact, last week I actually turned my robots on Thursday during our session, and then Friday ended up closing up with nearly, what was I think it was like 600 pips. I had 2 trades running on Aussie dollar, Yep, right there. So Aussie dollar for 146 and pound dollar for 4. I mean, that was over 600 pips after taking trades on Thursday during that session. So we're looking for some good opportunities. This week in particular, we're actually going to be talking about stocks and some of the stocks that we're interested in at really just some bargain levels. I think Tyson will probably touch on some option trading. I'm interested in a handful of stocks as well as what big currency pairs to follow as well. So super informative session, a lot of fun and free for all. That is Facebook Live. Just come to our facebook.com Market Traders Institute page. All right, traders, that's it for me. Have a great week. I'll see you all soon. See you in the Flex Trading Room. Let's make some pips this week. Take care, everybody. Bye-bye.